Welcome to Fear and Greed, the week ahead. I'm Sean Aylmer, and as always, I'm joined by economist Stephen Koukoulas. You'll find him at thekouk.com, TheKouk.com, and on Twitter using the handle thekouk. Stephen, good morning.
A very good morning to you, Sean.
Now, Stephen, house prices, let's get into it. We had the CoreLogic numbers last week. You're a man who thinks that house prices overall will fall kind of that 7 to 10% range. Others are going 15 to 20%. How are you looking?
And some are even more. Look, I'm pretty happy with my forecast because the CoreLogic numbers, while they did show a big decline in the month of August, 1.6% Australia-wide, the fall from the peak 4 months ago is now 3.5%. And while some people are sort of extrapolating and saying that there's an acceleration in this pace of decline, I'm not so sure. Clearly, we've got more falls to come. There's another 3, 4, 5, 6 months to go. But if you look at things like the weekly auction clearance rates, they're stabilising or even picked up a smidge in the last few weeks on average. And the rental market is as tight as a drum. And while the evidence is a bit 50-50 at this stage, there's some suggestion that investors are stepping back in, that they're taking advantage of a really tight rental market, an improvement in gross yields, and of course the tax system. We're not going to have a change in negative gearing rules, and that might just support the market.
Okay. Now, I mean, it's such a big week coming up, so I do want to get on to that. But just quickly, some of the stuff out last week, a few of the partial indicators towards GDP were a bit mixed.
They're a bit mixed. Yeah, CapEx business investment was a bit weak for the June quarter. I think there were buildings and construction was the weak side of that equation because of weather events, that a lot of construction was postponed. Equipment investment was nice and strong, so machinery and plant and that sort of stuff is coming into the economy quite well. Retail sales were remarkably strong. There was a big surprise for the month of July, 1.3% gain. So we consumers are spending. And there was a big fall in the number of new building approvals. So that construction pipeline of housing might just start to be tapering off a little bit. So mixed news on the economy. We're still growing, but maybe we're getting what the Reserve Bank wanted to see, and that's some moderation in the rate of growth.
Okay, now we will hear from the Reserve Bank tomorrow, in fact. Are they going to lift interest rates again, Stephen? Oh, well, actually, the answer to that's yes. How much?
Yeah, as a punter, I think you get $1.0001 on a hike. The question is that, a good one. How much? Look, I think on balance, 50 basis points is what they still need to do. That'll be the fourth 50-point hike in a row and follows that first 25-point move. I think the economy just needs it. The inflation pressures are still, rolling along. The labour market is incredibly tight. We've got, a real shortage of workers. And when you consider what the Fed is saying, they're already at 2.5% in the US. And Jerome Powell recently, Jackson Hole, a week and a half ago now, I think it was, is signaling that they're going to be hiking well towards 4%. So we've got to sort of keep a wriggle on. If we have a month or two where we only go 25 or something, we're going to fall behind the curve.
So rate rise tomorrow. But the big one this week, not often do you get anything that trumps 50 basis point rate rise, but we might this week with the GDP figures.
The GDP figures for the June quarter, and the partial indicators are coming through, as we said. That we know the CapEx numbers, we know real retail sales numbers. They came out a few weeks ago. We've got a bit of a handle on net exports from the monthly international trade data, and it looks like it's going to be a strongish number. My back-of-the-envelope calculation at this stage, and there's a couple of little things that come out later today and on Tuesday itself before the GDP figures on Wednesday, but at this stage it looks like it'll be about a 1.5% quarter-on-quarter increase. That's pretty strong. The annual figure will be sort of close to 4%, and I guess in a sense, when you think about why is the economy at over full employment? Well, if the economy is growing at 4% in annual terms, that's why. We've just got that momentum in the recovery from the COVID lockdowns a year ago.
I suppose the downside to that, though, is it still puts a lot of inflationary pressure into the economy.
Yes, and that's the issue. Yeah, we know from academic research, which does have a place in our analysis, of course, is that if the economy grows at about 2.75%, a little under 3%, that's a sort of speed limit, if you like, on the economy. And when the economy grows more than that, when it's sort of speeding along, that's when you get these inflation pressures building. So again, when we sort of reflect on, why is this inflation rate so high? Why is it so stubborn? One of the reasons, in addition to the supply chain problems which we know about, is that the economy has simply been very, very strong over the last 12 months. That'll be confirmed in the GDP numbers later this week.
Wow. Stephen, enjoy it. You're going to have a good week, aren't you?
Oh, it's so much fun. So many things to look at. And there's a whole lot of other indicators coming along too.
Fantastic. Thanks for talking to us, Stephen.
Thank you, Sean.
That was economist Stephen Koukoulas, better known as The Kouk. You can find him at thekouk.com and follow him on Twitter using the handle The Kouk. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.